Welcome. My name is Ian Scheuer. I'm a partner in the private equity and financial sponsors group at Travers Smith. I'm pleased to be joined by Katie McMenamin, who's a partner in our funds and funds finance team, and by Ed Ford, who's a senior associate in our funds team. All three of us are part of a large cross-practice team providing an end-to-end service for alternatives and private capital managers, spanning fundraising, fund life cycle events, house tax and regulatory advice, and of course investment and divestment transactions. So today we're going to take a whistle-stop tour around the range of sophisticated fund management and liquidity tools that many of our clients are now using in order to maximize returns and distinguish their offering. So Katie, Ed, let's begin by looking at what's been driving this increased appetite for portfolio-wide liquidity solutions.
Absolutely. So in most fund structures, GPs are operating really within a set exit horizon. So there's a general requirement to exit and fully realise the portfolio within 10 years or so. And sort of at the back end of the life of the fund, the GPs often have a limited access to follow-on capital. So against that backdrop, in a world where really it's very hard to competitive to acquire really good quality assets, GPs are looking at their portfolio and they're seeing future upside that they would lose if they were to sell by conventional M&A. So those dynamics, they've always existed, but right now there's a vast pool of secondary capital available, and GPs are really able to access that to provide liquidity options to the LPs, so they can either maintain their exposure to the assets or crystallize gains. Likewise, the GP can raise follow-on capital to sort of fuel the future growth of the portfolio. And so LPs within a sort of set investor base will all have different liquidity needs and expectations, and the GPs can really use these structures to tailor a liquidity solution to match those needs.
I think it's probably worth mentioning COVID and the impact that that's had on these trends as well. And as Ed says, these trends and these challenges for managers existed pre the current circumstances, but actually COVID brought that into quite sharp focus for many managers, particularly for older vintage funds where there's a lot of NAV in the ground, but perhaps they're light on on-call commitments. The liquidity issues faced by portfolio companies meant that managers were looking at solutions to support various of their investee companies, and they're not able to rely on on-call commitments to do that. They're not able to rely on borrowing against those on-call commitments to do that in the older vintage funds. So what they were looking to was the value of the NAV across their entire portfolio, which has led to a significant focus on portfolio financing options and other liquidity solutions to try and provide that extra bolster for the balance sheets across managers' portfolios rather than asset-specific financing packages.
Okay, thanks, Katie. So, I guess GPs are using these solutions not just to provide liquidity, but really to differentiate themselves in terms of returns and value add for investors. Maybe rather than sort of talking generalities, maybe we can get down to some specifics and talk about the options which are available.
Sure. So as Ed sort of touched on, this structure for closed-ended funds is obviously always had these potential sort of liquidity issues and challenges in them. The traditional approach for many managers was to have perhaps a subscription line at fund level, borrowing against your on-call commitments, dealing with your sort of short-term working capital needs at the fund level. And then asset level specific financing packages on an asset by asset basis. So putting in a new acquisition finance package each time you acquire a new portfolio company. These liquidity solutions are actually often looking at something sort of in between those two types of leverage. So actually looking to borrow on a portfolio-wide basis against the NAV of the entire portfolio and effectively cross-collateralizing the value of all your investments and being able to borrow against the entire value of that NAV and at modest leverage levels. So for some managers, that means putting an extra turn of leverage over and above what they might already have in terms of asset level. For some managers, it's a means of not having to negotiate, 10, 12, 15 separate financing packages, but they're able to put in one portfolio solution. So that sort of area of NAV financing, and we'll come on to the details of how that operates and how that interacts with pref equity solutions as well, it is really putting something in that middle slice of the fund structure.
Okay. Well, let's talk about this sort of the other way of tackling this, which is, I suppose, the more restructuring based option, and really talking about GP-led secondaries, which are now obviously being recognised for the potential upsides that they can offer to both LPs and GPs in terms of a sophisticated approach to investor relations. So maybe Ed, do you want to lead us off on this particular area?
Yeah, absolutely. So I suppose what a GP-led transaction would involve is a GP running an intermediated auction process and ultimately arranging for a secondary capital provider to acquire exposure to the fund assets. So that can be done in a number of different ways, but sort of two main ones would either be the secondary buyer acquiring interest in the fund itself, or acquiring interest in, or capitalising rather, a vehicle which itself would acquire the portfolio of the fund. I think in terms of pricing, it's set with a reference to the most recently available quarterly NAV, so typically a discount or a premium to that. And the GP will, having got LPAC approval to that transaction, will offer LPs the option either to exit and take liquidity, or to roll or reinvest the proceeds generated, so that the LPs maintain exposure on a sort of status quo basis, as if they did before the transaction. Likewise, the transaction, if it generates carried interest payable to the manager, that carried interest will typically be reinvested into the continuation vehicle as a sort of investor slice commitment. And on an ongoing basis, the GP will charge a management fee to manage the assets. It'll clearly receive a carried interest if the various performance metrics are hit, and the exit date will effectively be pushed out to an M&A exit sort of some years after the deal.
So I mean, these are complex transactions. You've got the GP, you've got the incoming providers of capital, the incoming investors, you've got the existing investors, some of whom will take cash, some of whom will roll. So they're complex to start with, but they're getting no less complex because we're obviously seeing lots of variations on a theme now. We're seeing strip sales, we're seeing end of life portfolios and single asset deals. There's no doubt these things are getting more and more complicated and sort of melded between sort of pure equity transactions or preferred equity transactions, and with a degree of leverage as well. I think the other thing to point out is that whilst this primarily started off in the private equity world, it's moved into various other structures. So you have infrastructure funds looking at this, real estate funds looking at this, credit funds looking at this. And I think that's only going to set to grow because, as I say, we've had sort of record fundraising in the secondary market for years now, and that there's billions and billions of dry powder there to be deployed, and everyone's very creative. And so I'm certain that we'll see this in private equity world, but also in other asset classes as a sort of a mainstream option going forward. And so really, when we think about our exit options now we should be really thinking about trade sale to another private equity house or private capital provider, IPO, but really this is another option now, which is just a sale to another vehicle, which the GP in effect still controls.
Yeah, I think that's right. I mean, it's not going to be the main sort of status quo option because it's a bit more complicated. That there are a huge amount of conflicts in these structures. Clearly, if you're selling to a vehicle that you manage yourself, and the price discovery process comes under quite heavy scrutiny. But where the GP has a sort of the right reason to do it, it perhaps needs the follow-on capital, likes the asset, has an edge that wouldn't be in place if a buyer, sort of conventional M&A buyer, was running the assets. Then yeah, absolutely, I think it would become mainstream. Okay, very interesting. So maybe if we move away from GP-led secondaries and maybe just talk about a couple of the other liquidity solutions that Katie mentioned before. Maybe let's start with preferred equity. Maybe so who's going to tell us a bit about those to start with? Yeah, I can jump in. So I think typical preferred equity structure within a portfolio involves a third-party capital provider, typically a fund, providing a sort of an upside capped, downside protected instrument within the fund. So they will look at the LTV, or sorry, they will look at the NAV of the portfolio. They will lend or provide a certain amount of capital on the basis that they receive a percentage of future portfolio distributions until they've got a set return. So typically that's an IRR hurdle with a minimum MOIC. There's no, or whilst that might look a bit like debt insofar as it's capped upside, there's no security given, and it's inherently therefore a lot more flexible as an instrument that the debt may be. And I think that's really the key marketing message that preferred equity providers sell. They say no security, therefore way less control than a bank would have over your assets. I think that those are the differences. There are also similarities structurally to what a sort of a NAV-based lend might look like, and I think Katie is probably very well placed to talk to us about that.
Yeah, so I think exactly as you say, preferred equity is characterised by not having a set maturity, so effectively can run alongside the life of the fund and the relevant assets. It's also very much marketed as, you know, there are no set repayment, there'll be no cash pay interest, so everything will be funded from distributions as and when they come up from the relevant assets. A NAV facility lender will look at the same portfolio through a slightly different lens, and they will require, in most cases, some form of security, probably not right down close to the top codes if we're talking about a PE structure, but somewhere further up, at least a single point of enforcement to allow them to effectively step into the shoes of the manager in a downside scenario and hold the residual equity value in the portfolio. There's definitely a convergence between terms of preferred equity products and NAV facilities, and you're definitely seeing a trend where NAV facility lenders are able to be much more flexible in terms of what are the immediate consequences if LTV drops for whatever reason, or you're not exiting your assets on quite the timeline that's required to meet perhaps the amortization profile or the cash sweep mechanics in the NAV facility that were originally contemplated. So we're seeing a lot more in terms of long grace periods, remediation plans, consultation between the lender and the relevant manager before actually any enforcement action can be contemplated, before there can be any discussions around forced sales of assets at a time when it might not be right to exit in that particular market. So whilst the two products and the two types of providers might come at the portfolio slightly differently, the terms are similar and actually probably converging rather than moving apart, I would say.
But given that convergence, how are managers comparing those two options at the moment? How are they deciding which one to go with?
As ever, and perhaps inevitably, often it's price, and typically you will see that preferred equity providers who don't have the benefit of any type of security will be looking at pricing that's more in the sort of low double digits, compared to NAV facilities where you're probably looking more, 5 to 10%, depending of course on the nature of the portfolio and the particular assets. It's also worth considering how diverse is my portfolio, what is my cash model for distributions coming up, how am I going to pay down the relevant debt, whether that's by way of preferred equity or a NAV facility, because that will often dictate whether, for example, a NAV facility lender can offer that type of competitive pricing. If you've got a more concentrated portfolio, perhaps it is fairly illiquid in terms of the assets in there and they've got quite a long exit profile, then preferred equity might well be the solution that's right for that portfolio. It also kind of depends on, in terms of the story for the manager and on what they want to use the capital for. Is this funding distributions to LPs, or is this extra cash to plough into the portfolio for follow-ons and bolt-ons, etc. And again, sometimes that can really play into whether you need sort of a form of flexible financing with future draws, and the ability to perhaps repay and redraw, perhaps to have much more flexibility in terms of allowing the portfolio to not necessarily be a static portfolio. That type of flexibility sometimes can be easier for lenders under NAV facilities to provide, as opposed to preferred equity providers who of course have to meet their own investors' return requirements. So it really does depend on what the story is for the manager, what the particular assets are in the portfolio, and what the cash is going to be used for.
Yeah, I'd only add that I think in practice what people are doing is they're running a dual track process. So the intermediary will go out and they'll speak to the sort of classic preferred equity providers, and they'll speak to the classic sort of NAV-based lending providers, some of whom are actually the same people. And you'll effectively get pricing for both options, and then I suppose weigh up the cost of capital and the flexibility sort of dynamic, and sort of make a decision on that basis.
Very good. Okay. Well, I think that's been a very helpful run through of these solutions. They are complex solutions, and and I think it's really important that you identify the GP's primary drivers to the transaction. It's important that you draw on the expertise and contacts across the primary and secondary equity and debt markets and the advisor universe in order to make sure you're tailoring the transaction to your particular needs. And despite the fact that these deals have been talked about an awful lot, and there is really a big wave of activity in this sector, I think it's still the case that a lot of GPs still haven't done them, and those that haven't are still are going to start looking seriously at these over the course of the next 12 to 24 months, I suspect, in order to make sure they're responding to the actions which have been taken by some of the earlier movers in the sector. So I think we should all be watching this space. Thank you for joining us. If you do want to explore any of these solutions further, or you need a bit more help in evaluating whether this is something which is relevant to you, then please do get in touch with us or visit the Travers Smith website.